How can you use the MACD histogram to better anticipate turns in a market instead of just waiting for the turn to happen? Hi, I'm Dave Keller, founder of Market Misbehavior, down in Orlando for the Money Show. I received a question earlier this week about using that weekly histogram and what it might represent. I'll use the weekly chart of IBM to show you what MACD or PPO histogram represents, how it relates to traditional buy and sell signals, what it might tell you to look for today. Before we get to the chart and a little more detail, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koifin. Koifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koifin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so here we're looking at the chart of IBM. This is a weekly chart. I'm just showing the last 2-3 years here. And now normally on a weekly chart, I look at a lot more data. I usually look at a 7-year weekly chart, but we've zoomed in a little bit just to get a little more detail, a little more granularity on the most recent price action. Just so we're all understanding what's happening here, we have the weekly open, high, low, close. We have the 40-week and the 150-week simple moving averages. I have RSI, and then I have the weekly PPO at the bottom. And there's a histogram there as well in blue. Now, the couple comments on this. Number one, this is my default weekly chart, although usually with a 7-year time frame. For me, this combination of indicators helps me analyze trend, analyze momentum, and then a tool to anticipate market turns and then confirm those turns as well. And that's what the PPO indicator is really designed to do, both of those purposes. Now, the difference between MACD and PPO, in case you're interested, they're almost synonymous, and in fact, they're actually quite similar. MACD was an indicator created by Jerry Apple decades ago. And he had the innovation of smoothing out the price data using exponential moving averages and looking a bit at the difference between those two moving averages as a measure of trend strength. And then he smoothed that out with a red signal line as a way of having a crossover system, right? So you have the main indicator, and then you have a lagged version of the indicator, and you're looking for a positive crossover as a traditional buy signal and a bearish crossover as a sell signal. Now, the PPO indicator stands for percent price oscillator. So the problem with MACD, or I guess the weakness or the challenge there, is that it uses absolute dollar terms, right? So it actually looks at the point difference, the dollar difference between the two exponential moving averages used in the calculation. The problem is if a stock is a lower price stock and then becomes a higher price stock, the MACD indicator becomes very exaggerated on one side and very muted on the other. It's kind of like looking at an arithmetic scale chart, and all of a sudden the price action gets really exaggerated as it gets higher. It's a little misleading. So the PPO does the same methodology, but it uses percentage differences instead of absolute terms. And so as a result, it becomes a better way of analyzing price action over longer periods of time. And because my time frame is a little bit longer, that's why I like to use it as a default. To be honest with you, if you have a shorter time frame, either one of those indicators is going to be pretty similar. I wouldn't be too concerned about which one you're looking at. So here we're doing the PPO, and as a reminder, the black PPO line is the main signal. That represents the difference between the 12 and 26 day, or in this case, 12 and 26 week exponential moving averages. And then the red line, which is called the signal line, is a 9-day smoothing of that black MACD indicator. So the traditional buy signal here in mid-July, this is when IBM had bottomed out in April, starts to rotate higher, and then eventually it's enough of an uptrend to signal the buy signal there. The most recent sell signal was at the end of March, so we actually topped out in early March. By the time we get to the end of the month, it's enough of a rollover to register the signal. So that right there should tell you, or hopefully help you understand, that the MACD or PPO indicators are a lagging indicator. Meaning it's not designed on this version of it, or what I've shared so far. It's not designed to anticipate a turn. It's designed to confirm a turn. It's more of a lagging indicator, right? So the market peaks, it starts to roll over. Eventually, it's enough of a rollover to register a sell signal. That's what's put in. As we go lower and lower, eventually we start to turn higher. And once the bottom is confirmed and the moving averages slope back higher, you get a buy signal. And so you usually miss the turn. It rarely, if ever, would signal before the reversal. It has to wait for the market to reverse, which causes the moving averages to turn, which causes the buy or sell signal to be completed. This is why the histogram was added as an additional factor, as an additional way of representing the change in the trend. And let's look at those same signals here, right? As the market goes higher here in February and March, we can see that eventually the sell signal happens in late March. But during this period here, look at how the histogram had been sloping higher into early February and then starts to slope downwards. That change there, because the histogram is actually looking at the difference between those two lines, the MACD or PPO line and the signal line. So the histogram measures the difference between those two. So when you get near to the sell signal, when you start to have that turn, the moving averages usually start to slow down because the PPO line will roll over while the signal line is still going up. That will make the histogram go down because they are getting closer and closer. So the change in the trend of the histogram is a leading indicator. That tells you a top is probably coming. You wait for the confirmation, the sell signal using the traditional measurements, and that confirms that a peak is in. Let's look what happened going into April and May. We sold off into late April. We can see the histogram now going lower. It's below zero because the PPO line is below the signal line, which makes sense. Eventually, the trend is down, and all of a sudden, the histogram goes from going lower to all of a sudden starting to trend higher. That's happening right during this period. And as you can see from the moving averages, the PPO line actually starts to slow down and then starts to turn higher while the signal line is still going down. That causes the histogram to lessen or to go a little bit higher because the lines are becoming closer, and that change in trend anticipates that we're probably nearing a buy signal from the PPO indicator. Here in mid-July, we can see that we finally got the buy signal. So the change in the trend of the histogram is designed to help you anticipate a potential change in the trend in the indicator itself. Now, does this always work? Of course not. Even on this example chart, you can see a time not too far before where I started here in December and then into early January. You can see that the histogram actually started to slow down, actually come off a little bit. The lines came closer, but they never crossed. That's the danger of just betting the house on the change in the histogram before you think that's the signal you should follow. It can be challenging because there can be some false signals because the trend can slow down before it reinitiates. We can see the same thing back here in June and July of last year, right? The histogram comes in a little bit as the averages come closer, but then finally it reemerges and it continues to go up. So how do we use this histogram? Well, when there's a change in the trend of the histogram, it can be an aggressive early version, right? So if you're more of an aggressive trader or an aggressive investor, maybe that's what you take action on. All I would caution you is to look at some of the examples where it did not play out particularly well. It can be an early warning system and sometimes not actually be confirmed. So as a result, you have to make sure you use good money management techniques to make sure you limit your losses or get back in if the trend reemerges. The other thing I would say is that the other way to think of it a little more conservatively is use the change in trend of the histogram as sort of an early warning system, or maybe put a partial position on, put half the position on in late May when the histogram starts to trend higher, then complete the position when the PPO indicator finally registers a buy signal. I think a lot of times investors, particularly newer investors, think a little too in a binary outcome, right? I'm either all in or I'm all out. Remember, you have a lot more flexibility in terms of how you can layer into position. Take a partial position on an initial signal. Once you get the confirmation from the lagging indicators, then you complete the position. That means you don't put as much at risk at the beginning, but if it does work out, at least you participated earlier on. What does that mean for IBM here in mid-October 2024? Well, notice that right now the histogram of this week has downticked just one little bit, right? So the histogram technically starting to come in a little bit. I would argue that is the early warning system, assuming the week ends right about here. And this is we're recording this kind of midday on Friday, the 18th. So if the week closes around current levels, that would mean the histogram is lower for the first time since late August, and that would indicate a potential red flag of a trend reversal. Again, that's the early warning signal. So what would also be helpful is to wait for a confirmation from the sell signal, right? Remember what we learned back here in February and March. The early warning system can be an aggressive form. Waiting for the confirmation to indicate that a downtrend is now emerging can be helpful as well. What do you think about using this weekly MACD or PPO indicator, particularly the histogram? I hope that this helps you understand the indicator a little better. I'm wondering how you use this indicator, or is there another indicator you use that you find even more helpful? Don't forget to drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts. Have a good one.